Well, September's continued to be a pretty good month so far, adding to a pretty good year. Our funds at Fortress are up. The Caribbean Growth Fund is up about 11% year to date. Our US Dollar World Growth Fund is up 13%. And even in the boring bond world, we're looking at gains of 4 to 5% in our bond funds. On the equity side, yes, US stocks are stronger. Yes, Caribbean stocks are kind of flat, as often they are. The real secret weapon this year has been things outside the US, so what we call international and emerging markets shares. Our emerging markets fund is up about 40% year to date. A lot of cheap stuff in China, Brazil, even places like Greece have rallied a lot this year, from what we'd call very, very cheap to now just really cheap. So I think we here, our global investors, will invest in the US, Caribbean, and all around the world. And this year has definitely been a year where it's paid to be investing outside the US. Now, speaking of the US, we're here recording this the day before the Fed meets to probably cut interest rates. So I think by the time you're hearing this, the Fed will have cut, we expect 25 basis points to a rate of 4 to 4.25%. That's their first cut since December of 2024. They've basically been on hold since then, probably letting the tariff thing in the States play out to see what the impact on inflation would be. But they're starting to see some impact on weaker economic data out of the US. So the first cut comes. Now, of course, financial markets have priced this in already. We've got two-year bonds in the States yielding 3.5%, which would suggest that investors are already thinking rates will continue going lower this year and into next year. The question now, though, is how fast can the Fed cut? What are investor expectations? And what happens around the economy as the Fed cuts more? So we'd be in the camp of thinking yes to the Fed cutting more. However, it's going to be a rare situation where you're going to have everything still being pretty good in the economy as the Fed cuts. So don't be surprised to see a little bit of choppiness, maybe some concern about the economic conditions. And we need now, and especially now, always, to be careful of high expectations. In the equity market in the U.S., there probably are some sectors that we'd say embody too high expectations, areas where we haven't invested for some time and aren't now. U.S. technology is one of those sectors, by and large, or has some expensive stock. But I think generally, if we've got when we think about what's going on and what the outlook is from here, we're still very, very positive on global equities. Interest rates are still pretty good. And I think that you're going to see some pretty good returns coming in through the rest of the year. I would add some buts, though, and here are the buts. The next quarterly earnings coming out, we're going to need to pay very close attention to pressure on profit margins that are coming from tariffs. We're also going to have to keep an eye on any slowdown in the labor markets and what impact that's having on company revenues. We'll also have to see how fast this interest rate cutting regime or program continues after this first cut. And I think also, to bring it back to valuations, a lot of the market gains in the US especially have been in the hands of some very large leading companies, and their valuations are not cheap. Now, again, back to being global investors, we're finding lots of good things to buy still around the world. Nothing moves in a straight line, though, so it wouldn't be surprised to see a little bit of choppiness over the next little while. But the outlook from where we sit still looks quite good indeed. And that is it from here.